delving into stocks, property, bonds, economics, and more. This is the Stock Market Mentor podcast. Taking an unconventional stance, we challenge the industry to help you protect your investments and empower you with the knowledge to become a savvy investor. We don't provide financial advice. Here's Steve Moriarty, Tom Hill, and Jacob Sr.
All right, welcome back to another podcast for the Stock Market Mentor. What we're going to be going through this afternoon, gentlemen, is skill versus luck.
Excellent.
How are we feeling?
Good one. Yeah,
I'm all right.
This one pops up a lot of. So I'm interested to get through it all.
Let's bag the experts. Let's get into them right.
We're back.
Bloody experts. Don't know what they're talking about. We do though. Righto, fire away, Tom.
Yeah, look, the intention of this, right, is just to talk through skill versus luck. How much skill do you actually have to make money in the stock market? And what role does luck actually play? Yeah. I mean, like at the end of the day, we're not saying that it takes no skill. Blind Freddie's probably not going to come in here and start beating Warren Buffett. What we're saying is, what level of skill do you actually need?
Yeah.
I mean, look, the things that we do know, in the stock market, you can only do a couple of things. You can either buy, you can sell, or you can sit on your hands. There's a lot of things we can't control. For example, we can't control the entire macro environment. We can't control what the billions of other traders are doing with the market. We can't control what companies are doing, what management of companies are doing, and we have absolutely no control over trade wars.
That's where the luck comes in.
Exactly. Yeah. There's definitely stuff in our control though. So, where we're at in the market cycle, for example, so we can make sense of the macro environment. Yeah. We can understand the pattern. So we know history doesn't repeat, but it definitely rhymes. So using that information, make better decisions. We can control.
Saying.
Yeah, I know. I didn't come up with it myself.
What's that?
Look, we can come up with, asset allocation. That's something we have control over, making sure we're not going all in on mining stocks, Jacob.
Yeah.
And
penny mining stocks.
Pick on me again today.
Yeah. And are we buying, selling, or waiting?
Yeah. No, good point. It's an interesting one because one of the previous podcasts we talked about stock picking, and that the natural link is, this guy or this girl must know what they're doing, right? Because they're an expert. I mean, I've got a master's of finance, so I'm, quote, an expert. Yeah. But that doesn't mean I'm actually going to be
100% right every time.
Yeah, because there's a lot of luck involved in the environment, and it's a lot different from, fixing a car or something.
Yeah, well, that's fancy you saying that. I was just going to talk about fixing a car, Steve.
Mustang boy.
Don't bring those memories back. No, I think it is important to acknowledge people don't acknowledge how much luck is in this market because the experts want to be perceived as experts for the long term, right? So imagine I can ask both of you a question. Go to a mechanic, you've got someone that you've been to every single year for the last 10 years. They've done their trade, they've fixed your car every year or whenever it needs a service for the last 10 years. They've got this inherent trust between you and that person. However, when you're looking for a quote-unquote investor expert, you can Google it, and then as soon as you start asking them questions like, well, have you beaten the market? Or when was the last, how many years in a row have you beaten the market, for example, and they can't answer you, or they give you very specific time frames, you start to ask yourself, well, is it something that can actually be...
did they get lucky rather than,
or unlucky?
Well, yeah, because what you were saying about car is I was just thinking, you generally... My car's not running right. You take it to a mechanic, you jump in it, drive off.
And it's fixed, yeah.
That's skill, right? Yeah. There's a demonstration of skill right there. Yeah. But in the stock market or in, property investing or anything, any investment field, it's generally, you can buy a stock or an ETF or anything, and it's not automatically like, oh, cool, you're totally skilled because you made a lot of money. You've actually got to wait to see what the outcome is. Yeah. And then, as you guys know, you can be up 100% in 12 months and think you're a genius, and then, lose 80% of it within 2 years. And you have to go, well, hang on, was that good skill to start with? Yeah. And like you say, then you got lucky, but then you got really unlucky, and actually it sucks because you don't have any skill at all.
Well, you wouldn't take your car to the mechanic if he said, "Oh, mate, there's a 50-50 chance of this going." If you're driving down the road today, you'd be like, "Hold on a minute. Well, I might go check somebody else out."
I'm not paying you for that.
Or it'll work for another 6 months, but then it might break down again.
Yeah,
You're going to be that sense of luck in investing is not given enough weight. And it's for a good reason, right? It's because the incentives behind it are to give your money to an investor. They jump in and do it for you.
Yeah.
It's going to be okay. Just put your money in the market, and all in the meantime, they're getting their fees.
But you think about to me. There's obviously, I think you were saying before, Tom, or in the previous one, you're saying, we're not saying there's no skill involved. And it's also reminds me of what, Nasib Taleb said. Look, I'm not saying he wrote that fool by randomness, right? Yeah. And everyone ran around going, the whole world's random, the whole world's random. And what he said was, look, it's not 100% random. We're just saying it's more random than you think. Yeah. And it ties into the market because it's future-oriented. You can be – I mean, even Warren Buffett has had some absolutely howling duds of investments, and IBM is one that always comes to mind. Where if you listen to Warren Buffett, you'd sort of think, oh, well, this guy's got lots of skill, and he still picks dud stocks. Charlie Munger, I think, said he's made most of his money in 4 stocks.
Yeah.
So you sort of go, that's a skill, but you also have to think, well, geez, he must have been, he can have a good process. I'm not arguing there, and that's what I am arguing for. Yeah. But you'd also have to say, well, geez, he was pretty lucky that he held on.
Yeah.
He has it allocated right.
Well, that's the thing, right? I can already hear people listening to this screaming, well, how the frick do we know if I'm being lucky or if I'm being skillful? And I think it's worth just noting a couple of points where what are the controllable factors that determine skill and what are the uncontrollable factors, to your point earlier, Tom, that determine luck. And I think what you've just mentioned there, which is understanding how to asset allocate, Steve, understanding how to actually manage your psychology, what is risk aversion, all of those things. If you're interested in actually getting into the market and investing, what are the things that you can actually control?
Yeah. And sorry, Tom, you go.
No, I was just going to say, the key message is, right, we're not downplaying the role of skill, but how much skill do you actually need to make money from the market?
Probably not. Well, we'd argue not much.
Well, that's the thing. I can tell you now, I've done just fine, and I don't know how to read a company report. Well, in fact, I don't read company reports.
Yeah, balance sheets
and
stuff.
There, living in the data. It's a matter of just, taking a very high-level approach, understanding where the market is at a whole, asset allocation.
Yeah. Well, it's an interesting point, actually, because it even within... Yeah, like you say, how do you measure skill? And, our argument is, and this is what I say to people in the course, right? It's a bit like there's 3 main things. Market cycles, right? That's the first thing. If you buy at the top, I don't care how much skill you got, you're probably going to do money, right? And history bears that out, right? The second part, and alternatively, if you buy at the bottom of the market, then you'll do really well. Not because you're skilled, but also because you're just, you're lucky.
Like everyone who bought a house in the early 2000s.
Yeah, exactly. Everybody thinks they're skilled at what they're doing when John Kenneth Galbraith, the famous economist, said, don't mistake genius for a bull market. And that, I think, is what happens quite a lot, not just in stocks, but in property as well, where you basically buy because the bank gives you a loan. And I think we talked about this earlier on. I had a mortgage broker who was signing up, hundreds of thousands, millions of dollars. So I was like, oh, this is really good. Prices were going up. So there wasn't, I never sat down and went, do I really know what I'm doing? Do I have any skill?
I'm leveraged up to the nines.
Do I have any skill at this, But it was, and that's what I mean. It was actually just luck, but to get back to what you were saying, Tom, the question is, how much skill do you need? Our argument is probably not much, but the other one is too, how much luck do you need?
Yeah.
And if you Steve, I only buy when the Cape ratio's at 10, or I I have a conservative asset allocation plan. I only buy the permanent portfolio, which is, gold, cash, US stocks and US bonds. So you got, 4 asset classes, and you rebalance. You look at that and say, that doesn't require a lot of skill, but you can still be quite successful. And indeed, that's what
process.
That's what we're arguing. If it always brings me back to golfers or tennis players and what you're saying about process.
Yeah.
Right. Because they've hit 10 million forehands. Well, they're probably going to hit a pretty good forehand.
Yeah.
But like you were saying, Tom, they can control the racket speed, their feet, they can practice it a lot. But you can study markets for a long time and still fail, which reminds me, Stanley Druckenmiller, wasn't in tech stocks, and he sold out in, I think it was September 1999, and then couldn't bear it because they just kept going up. Jumped back in again, I think, in 2000, and then lost like I don't know, bloody 300 million or something in the collapse of you look at that guy, and he's done, I think the other day, 30% a year for 30 years.
Yeah, since.
Right? But you can still be really, really good and fail. Whereas if you're fixing a car, you generally, you drive it away and you go, yeah, that worked. Right. So but it's interesting what you say about process, because it's a really, really important part of understanding how to invest and making sure that it's simple.
It's not necessarily skill for 90% of people. It's actually they have a solid process. That's why they're consistently performing. I think an interesting thought, maybe a thought-provoking question is, I wonder how much impact experts actually have on somebody's long-term portfolio, because the data would suggest that since 2000 they've just been in a raging bull market, or since 2009 just been in a raging bull market, and then for the 9 years before that, you
lost 50%.
Well, that's what I mean. Any old Joe could have taken somebody's portfolio as an expert in the raging bull market, and the turkey can fly in a hurricane. And just while you guys were talking, it just got me thinking, I wonder how much real, genuine impact and decisions that those people make actually have on somebody's portfolio over the long term.
Well, it was, again, what we were talking about previously about stock picking.
Yeah.
Right? You can get, and like I think we said before, if you get in a bull market, you can pick stocks that can do really, really well, not because of any skill, but simply because you're in a bull market.
Yeah.
Right? But nobody ever says, oh my God, I was really lucky I made lots of money. Everyone tells you about how clever they are. Because no one wants to go, oh yeah, I don't know what I'm doing, but I just got really lucky. It's like winning the lottery and going, oh yeah, I knew what I was doing. It's like, no, guys, someone just pulled your ticket.
Yeah, that was your numbers out.
So I suppose what we're arguing for is, as you said, Tom, skills necessary, but sort of how much do you need? But the hard part is how do you measure it?
Yeah.
Like that's why I argue that experience is more important.
Yeah, it definitely is more important. You got this, and the experience through the cycles and bad times, I think, add so much more value into somebody's arsenal.
Well, that's why I was saying, if you focus on not losing money, what we find is, and we talk this about market cycles, right? If you get the upside, you can get that via luck, but it's avoiding the downside that requires skill. And most people fail that because they don't understand the market cycles. And so, and as we said before, if you've got experts managing your money and it's about investing through the whole cycle, then you'll always end up generally, or not always, but you end up mainly with the average return. And what we're saying is, look, you can get pretty close to buying at the bottom and selling at the top and still make more money than holding through the cycle. And we're going to talk about that in future editions about compounding and how that actually works. But it's that's the point we talk about. like we say, focus on not losing money, because if you think about it, and I sort of mention this often to clients, that if you bought in 1982 when the cake was at 5 to 2000, you made 16% a year. If you said, okay, I'm holding, I'm just going to hold through, when you get to 2009, that's been melted away to 8% per year, right? And where you look at that is what the performance of most fund managers is, right?
Or they pick out a specific section of time between A and B that's
and it looks really good.
The perfect amount of investing time, and they've made 30% year on year.
Well, that's what they're doing since March, right? 2009.
It's crazy.
Like, this bull market's like 500% or something. But
like one more year, and then what is it?
Take it from 2007, and the returns are miserable. And it's, again, what we'll talk about later in the sequence of returns. If you start at 100 and go to 50 in 12 months, it's a hell of a long way to get back to starting again. And that's what happens. If you start in 2000, you lose 50% to 2003. So you've gone from 100 to 50. Then it doubles from 03 to 07, which you tend to sort of think, oh, man, that's fantastic. Yeah. But if you started in 2000, you're just back to where you started.
Yeah.
Right?
Yeah.
Now get this. 2007, you go, oh, fantastic, I'm back square.
Yeah.
Right? Then what happens? You lose 50% again, right, to 2009.
Tom, what was that? We're going to talk about crypto now for a minute. Sorry, everyone over the age of 50.
Thoughts and prayers.
But what was that crypto we're in? We put like a couple $100 in and ended up going up to however many thousands, and we thought we were geniuses and we're super skilled in the market and we know how to pick all these coins. Oh, I can't remember what it was called.
Which one?
Oh, there was a few, yeah.
But what, like dog coin or?
No, we weren't that dumb.
Safe Moon or it was one of those ridiculous.
The whole market was going crazy. And you tell the story. We just put some cash in. Next minute, we looked at the portfolio like, whoa, look at that.
Why? Because it took off.
It just went crazy.
Absolutely. Yeah. But the good news is, like, now when that happens, because we put a little bit in the specky, as painful as it is, we take the profit off.
Absolutely.
Or at least the initial investment.
Well, what's that process then?
Yeah.
We're actually 100%. The process.
But that is like,
it's so
everyone
hard.
underestimates how hard that is.
Yeah, absolutely.
Like, it's
selling a winning stock is so hard, because this is my own theory. You don't get bragging rights anymore, right? Yeah. Like I did that with some stocks that I was up 300-400% or something. And when I sold it, because I'd sold the first tranche first and I'd bought them as they'd risen, my 400 return was then about 80 or something, right? 80%, which is still great. Yeah. But it's not dinner table. It's not 100%. But you can't, you really feel as though, I bought ABC, and I made, I've only made 80 now, but I had made 400. You feel like you really got to ramp it up.
Well, we were doing like thousands of percent. I remember Tom on the phone of me going, Jacob, what the hell? What's going on? Like, have we cracked the market? We're going to be on our yachts next year. Yeah. And then we sold half at the top. We actually made a good decision. But
that wasn't you guys. That's a perfect example of luck.
Oh, yeah. Now we know. At the time, we were picking out golden crowns and stuff to wear. And
I was close to telling him I sold and not selling. Just going off.
Why? Because it went up. Because it went up so much.
No. Thousands. Probably going to go up another 50.
Yeah. You always do that
50 times.
Yeah. But that's the hard. That in itself is a skill.
It is knowing, telling yourself
rebalancing. I think asset allocation's quite easy because you can be more systematic. Whereas when you're rebalancing or selling out, that's the hardest decision because it like you say, Tom. Generally, if you're selling a stock that's rising, it's going to go up further.
Yeah. Well,
and in 2 weeks' time, you're going to be looking at it going, oh, I knew I should have held on. Yeah. Right? I do it myself, even now. It's like, all I do, and this is a hint, all I do is say, I add it and go, okay, so I would have made an extra, 2,000 or whatever, and
that's dangerous.
But it makes
I wouldn't want to do that.
But it puts it in perspective of saying, okay, well, it's not like I missed out on Apple at $5, and now it's 140 or whatever. I'm just saying it helps if you actually say, well, it's an extra $500.
Yeah.
Which is, you know what I mean? Like, it's not a lot.
There's an interesting, I'm not sure if you read the book, Turtle Trader with Bill Eckhart and Richard Dennis.
Yep.
And they actually put more into the market. Well, they first of all understood what trend trading was.
Yep.
But then each time there's and again, there's kind of 2 points here. It's understanding when to pick the market and when to get in the market and what your niche is, which is, in their point, trend trading.
Yep.
And the second point, which was follow the systematic process. So every time it upticked and cleared the last 20 days high, I think it was, they actually put more money into the market.
So momentum
and follow the
sort
trend.
of stuff.
Yeah. I mean, the wins were absolutely incredible, but then the losses and the drawdowns were also, I wouldn't have that headspace to be able to keep adding, and
as it falls,
and then as it goes up.
Oh,
but then some black swan event happens and it goes. Because you're actually buying the stock price and it's going up in value. When it collapses, you just
But
lose
isn't that interesting? That's a perfect example of skill. What you were saying before, Tom, about how much skill do you need? And that was the movie, Trading Places with Eddie Murphy. Yeah. Well, that movie was based on turtle traders because the argument was, you can't teach these people to be successful traders in a short space of time, I think. And
they just said anyway. So Bill Eckhart said he's a mathematician, statistician, said you can't teach people how to trade. It's an inherent born with skill.
Right. Okay.
And Richard Dennis said that's a lot of nonsense. I bet I can teach monkeys how to trade. And so they actually put an article in the New York Times over a couple of weeks and did interviews for people. Obviously, they weren't just going to take any old Joe, but they had people that were really, really smart doctors, and then they had people that were just general everyday workers, worked in news agents and things, and every single one of them learned how to trade. And it was actually quite often the people that followed the process that didn't overthink things, that worked in a random news agents that actually ended up becoming millionaires and fund managers that consistently won. So
because I think but it's true what you say about the systematic process, and one of the skills again is, which I try to teach people in the course, is about controlling your emotions, and it's actually a better skill than being able to interpret 25 balance sheets or whatever that really difficult stuff. And Warren Buffett said, if you can't manage your emotions, you won't be able to manage your portfolio, and it's so true, because just on that turtle traders stuff, the guy said, don't overthink it. Yep. If it says sell, you sell. Yep. If it says buy, you buy. That's it. Just follow the signals. Yep. But again, it's really hard to do.
Oh, I tried it myself for 12 months. It's the most crippling thing.
Yeah.
But it just goes to show, they took a group of people, when they ran that experiment. They didn't all get the same results, but they had the same set of rules.
Exactly.
Yeah.
As human nature.
But that's what I'm saying. That's the emotional stuff involved. But one thing, did they all buy the same stocks?
They all had the same signals, same stocks. Everything was the same.
Right.
And
so there's no luck involved, as in, you got lucky by buying ABC instead of XYZ or something.
Yeah, I remember the story. They didn't follow, the things that people wouldn't follow is the strategy mainly around the asset allocation. So if they had a gut feeling that even though technically the trade was there, then they wouldn't put the full amount.
Right.
So they missed out on the return.
So they're using their emotions or subjectivity.
But that really applies to the market too, right? So when it's really cheap, it's really hard to buy.
Yep.
And that's when you need to do it. And when it's
really
it sounds easy. Yeah.
It sounds really easy.
When the market's really expensive, that's when you need to take some profits off
the
table.
So fascinating.
That's why I prefer buying ETFs and sectors, particularly sectors. I have country strategies as part of the Well 2 program, but sectors as well. Sectors doesn't perform as well, but I just feel so much more comfortable buying the the XLE or buying the consumer discretionaries or something when they're cheap, because I just think to myself, well, they'll probably be all right. Whereas if you go to if you look at skill, and like we were talking about previously about stock picking, it's just like you do look at it and go, oh, that's just a nightmare.
Yeah.
I just think it's so much easier to buy a country, an index, a sector ETF or something like that when it's cheap, even if it's over a company that's cheap.
Yeah. So going back to the purpose of these, which is a skill theory incentives, time theory incentives in the market. I think the theory behind it is that the industry is saying buy stocks and hold it. You got to do the research, get your skills, get your master's degree, whatever it is, read the balance sheets. And what we're saying is actually there's a bigger picture way to look at these things, and there's a process and a system, which is the real skill that you should actually invest your time in first. Yeah, and please acknowledge the fact that there is an inordinate amount of luck in this game, and you're not a genius most of the time.
Well, most people fail not because they can't understand for example, we have 8 principles. It's not because they go, oh, I don't understand all those principles. It's because they don't understand themselves, right? And, all the ancient philosophy is know thyself. And I think I wrote in the first book with Low Rates, High Returns that, someone said, if you don't know yourself, the stock market's an expensive place to find out.
Yeah, you find out quickly as well.
and it's painful. Yeah. But it's actually true. And that's what you were saying before is so important. If you, even if you are a know-nothing turtle trader, if you stick to the system and it's just, it works, well, that's all you've got to do. But it's so funny because you also, you can sort of look at it and go, man, I'm going to kill this, because, I absolutely get how this works. Mm-hmm. But then when you actually invest your real money, it completely changes the whole vibe of like, oh, I'm not so sure at the moment.
So what are the incentives on this topic then? Skill versus luck. Where do you think that comes in?
Well, money to be made overcomplicating it.
Yeah.
Right? Get the experts to do it.
Yeah.
I couldn't be as skilled as, that fund manager. He must know what he's doing.
Yeah, and he can probably do a lot of things better than we can. But what I'm saying, you don't need a 7-year degree necessarily to be good at this.
Well, because of the luck involved.
Correct. Yeah.
So how do we finish this one up? What do you sort of think? What have I got here? I've got here some skill helps, but for most of us it's simply a matter of seeing what delivers results is what we argue, which is market timing or market cycles.
Playing the odds.
Right. Survival, which we're going to talk about further on, but that's a really big one. But again, when we talk about, where do the big hits come from, as in the big winners, and it's essentially using things like CAPE, the cyclically adjusted price earnings ratio, or the earnings yield. And even looking at those two will make you a better investor than probably 85% of fund managers, since they don't beat the market. So when we sort of look at it from that perspective, we're sort of saying to people, look, you don't have to be that skilled. You don't have to read 1,000 books about valuation, blah, blah, blah. You can actually have a really simple portfolio, which is what I show people in Wealth 3 in terms of their superannuation. Because you've got all these ETFs now that, 50 years ago you didn't have. And so you had to go to the industry to actually invest your money, whereas now you can do it yourself, but the industry is so much more slicker now in their marketing about how to tap into people, to sort of to sell their skill.
Yeah.
But I think, as we said in a previous episode, if you said, oh, mate, tell me how many winners you've had, and they said, well, 85%.
4 out of 10.
Well, yeah, but 85% of us don't beat the market.
Caught a fish this big last week. Well, there's no money to be made in your fund manager saying, "Oh, you know what? Just wait 5 years. They've got no assets under management for 5 years, and they're not going to go fishing." So they always constantly wanted to make this money, and they're not going to tell you just hold on. It's like going to a barber, and I think we mentioned this in a previous podcast. It's like going to a barber and they're saying, "Oh no, mate, you don't need a haircut today."
Yeah. The argument I made earlier on, I think in low rates, high returns, was they make money from getting assets under management, right? Funds under management. That's why they're all mad dogging about trying to get money, because the money is not in their stock selections. The money is actually made in the fees.
Exactly, yeah.
And that's where you look at it and say, well, if they said, look, Steve, the average return is 8 and we've done 11 for the last 40 years, you go, okay, these guys are really onto something. If they said, we've done 11, like a lot of them have, in the last 10 years, you go, well, okay, but so is the index, i.e., well, you guys haven't got any skill because the market's made 11%. So you've got to look at it over the longer term. But then, as I said before, you tend to sort of think, oh, they must know what they're doing because they've got a big house and, Mercedes and all that sort of stuff. But that's come from actually fees under management, not from actually saying, I'm a successful stock picker. And like we talked about in stock picking, into picking individual stocks, you've got to really, you've got to have some sort of special talent. But what we're saying is you don't need that much skill, like Buffett with his 4 filters, or someone saying, listen, mate, market cycles, asset allocation, rebalancing, get those 3, you'll probably knock over 95% of investors.
Yeah, and the 4 filters are what? A process. It's a system.
Yeah. And it's really quite simple. But the thing is, in my mind, we associate that is all skill rather than saying, well, there's a whole lot of luck about, getting in at the bottom of the market, selling out by accident at the top, or those sorts of things where we tend to think you've got to be really skilled in some area.
Yeah.
Where in actual fact, I don't think it is. But anyway, look, let's leave it there. Thanks for listening, folks. Thanks, gentlemen.
Pleasure. That was a good one. Go and read Turtle Traders.
And we'll see you next time. Cheers.
That's it for another episode of Stock Market Mentor. We hope you have enjoyed the show, and if you have any questions about the episode or want to discuss how we can help you become a better investor, please feel free to contact us at support@stockmarketmentor.com.au. We'll see you next time.